Welcome to the stock play of the day. Today's stock is XBI. That is an ETF that tracks the biotech sector. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest.
Well, Lindsey, we have a chart of the S&P 500 index up here, the good old SPX. We have a lot of earnings coming out this week. What do you see going forward for the week?
Yeah, this is one of the busiest weeks of earnings season this quarter. So there's going to be a lot of news and a lot of going on today. It's kind of a quiet day, so you see starting out with a bit of a muted tone, a little bit mixed across the indices. We see the NASDAQ up at the S&P 500. I think it's green right now, last I checked, down, and just kind of trying to determine the direction from here. This is after 3 weeks, 3 up weeks in the S&P 500. And like I said, we're heading into that this week with a big earnings week. We've got some of the Tesla coming down the pike this week. Some of the airlines, which I know a lot of our customers have been trading in and out of, we'll get results from them for the quarter. And I think a lot of people are anticipating, highly anticipating what they're going to hear from the travel industry this quarter and see how things are shaping up as we head into the third quarter. So it's going to be an important week from that perspective. Economic data is a little bit light. We'll get existing home sales on Wednesday, and then on Friday we get some PMI data, new home sales, and of course jobless claims on Thursday are going to continue to be important. But again, today, Monday, going into the week, it's a little bit quiet, so it's not surprising that we're not seeing the market really being having conviction about direction today. We do see a little bit of odd action when you look broadly at the market versus the VIX and gold and some other things. The VIX is coming down today. Like I said, the S&P 500. There are some headlines. We're going to get more into some of the vaccine news that we got out today, this morning, and over the weekend, which was positive. We'll talk about that. Talk about our stock play of the day. And then also this week, another thing that the market's going to be paying attention to is going to be stimulus out of both the EU and the US. There's a lot of negotiations going on about what the next stimulus package is going to be, because obviously the coronavirus pandemic is continuing to have a major impact on our economy. And the market is expecting that lawmakers here in the US can come to some agreement that will both benefit individuals as well as smaller businesses. I think the price tag we're looking for is somewhere between 1 and 1.5 trillion. I know Democrats have been throwing numbers like 3 and out, but I think the market will be happy if we get closer to that 1 to 1.5 trillion or anything on the high end of that. But anyway, Brian, like I mentioned, there is a little bit of a disconnect here between the market. We've seen it move sideways before for several days before popping up at the end of the chart line that you have there, following the trend line that you've drawn, all while the VIX had been stubbornly high for quite a while. This morning, we're finally seeing it break below 25, which feels encouraging. But what do you make of all the action?
Well, I'm going to say stubbornly is a very good word for what the VIX is doing. You're right. We'd like to get that to drive down a little bit, shows a little bit less fear in the marketplace overall, but there has been actual volatility to go along with the implied volatility that the VIX shows you. But if we look at the chart here, one of the things that we highlighted last week in the stock play of the day is that we had 3 or 4 days where the market just sat and did nothing. We're right on that trend line when that was happening. And we mentioned actually that it would be good at this point in time. It was kind of setting up a springboard. Is it going to break lower hard, or was it going to break higher hard? That was a possibility. We did have the big update on the following Monday. We had that update or the next day, I should say, on the Tuesday, we did have a fairly decent size up day, but then it came right back down again, and we're back into the consolidation phase. Now, obviously, you see this high that we had in the middle, well, at the beginning of June, seems to be providing a little bit of a resistance to the upside on the marketplace. But this is the first time where the market's really been just trying to decide, where do I want to go? Do I want to go higher? Do I want to go lower? We're finally getting a little bit of a pullback in the VIX, saying that there's a little bit less uncertainty, but we're coming into earnings season. As you mentioned, there are a ton of stocks that are going to be announcing earnings, some big tech stocks. The airlines are going to be probably one of the more interesting industries to listen to and watch and see if they're actually doing a little better this quarter, if they're making some progress overall. All right, so that's the S&P 500 index. Today's stock is going to be XBI, the Biotech ETF. What are we seeing there, Lindsey?
Before I get into, I'll just remind our viewers that are watching live, Brian and I will take your questions at the end, live right here. So be sure to get active in the chat box over on the right-hand side, and we'll get to those at the end of the show. We always look forward to any questions that you have. But yeah, let's dig into the XBI. It's the Spider Biotech ETF. This is an ETF that obviously we're looking at the chart right now. It feels like it's gone to the moon. I think today it hit another new 52-week high. So, you know, when you're talking about a stock like that, it can be a little bit difficult to talk about a trade. It can be a little nerve-wracking, but that's why we have Brian here to help us with how to trade the options around something that looks like, here to talk about the fundamentals. But as a reminder, please don't take anything Brian or I say as investment advice. We're here just to educate and help you learn about investing. So that's just a quick reminder. But okay, so the XBI, it is up on a year-to-date basis, 25%. And that compares to the S&P 500, which is just slightly down, kind of flattish on a year-to-date basis. So clearly outperforming. The coronavirus pandemic has obviously boosted a lot of these biotech stocks, have become front and center of the news headlines. We are driving as fast as we can, our healthcare professionals and scientists trying to find a vaccine so that we can resume normal economic and daily activity. And so that's why it's been such a popular trade. And we've gotten some good news. Heck, over the last couple days, we heard from Pfizer and BioNTech again. We heard from them last week. We're hearing again from them today that they're seeing positive signs in early stages of their trial. Oxford University is working with AstraZeneca. They're seeing good signs in early stages of their vaccine trials. And then also a British pharmaceutical company came out and said that they're seeing positive reactions to what they've got going on. The WHO, basically the World Health Organization, is saying that there are over 100 vaccines in development right now. So, you know, that's a great story to tell. And hopefully we find the vaccine that's going to be the cure to this sooner rather than later. But science does take time to prove out. So that means that it's possible that this ETF could continue to rise while the search for the vaccine is found. What we like about the XBH, in other words, there's a lot of momentum around this story of finding a vaccine, okay? And the reason we're looking at XBI over IBB, which I'm sure a lot of you have heard of, that's the iShares Biotech ETF. The IBB, they track more of the larger cap biotech names, and it's a market cap weighted index. So 10 securities out of over 200 account within the ETF account for 50% of the weight of the ETF. So you have concentration risk there, and with names like Amgen, for Vertex, and Gilead, they're in the top 3 or 4 names within that ETF. The XHB, on the other hand, it's not market cap weighted; it's equal cap weighted. So it's equal cap weighted and has exposure to some of the smaller or mid-sized biotech firms that are also searching for a cure. So while it has names like Vertex and Amgen and Gilead within the index as well, most securities within the XHB, or XBI, excuse me, XBI, I'm getting my letters mixed up. Most securities within the XBI, rating of 2%. So you have Moderna in there, which has been another one leading the way with vaccines, and some of the other names that I mentioned earlier in there. So this is the XBI that we're looking at. It doesn't have the concentration risk that IBB has. It's more diversified because of its equal weighting. And so the top 10 here, remember I said IBB, the top 10 holdings within that ETF account for 50%. The top 10 holdings within this ETF only account for less than 15%. So that's the difference between the two and why we're looking at XBI. Now, looking at either of these ETFs, it's really just a nice way to play and take advantage of all being done on a vaccine for COVID-19 vaccines, and also different types of treatments. It's also a play on increased innovation. It's a play on increased trend to market is what we're getting through government approvals and all the red tape there a lot quicker. And we've even heard some of these companies, like we talk about tech a lot of times, they've pulled forward, they advanced a lot of activity in a short period of time that would have taken them years to get done. Same thing happening within the biotech space. And a lot of times people have shied away from the biotech space in the past, especially the smaller companies within the XBI, is because they've had, been highly indebted, so a lot of debt on their balance sheet, cash flow. They're researching more vaccines and drugs, but over the last 5 years, they've improved that situation significantly. And also now, these companies, not just the small ones, the big ones too, they're getting grants from the U.S. government, the federal and state governments. They're trying to do as much as they can to expedite the development of these drugs to fight the coronavirus. So that's why it's an interesting security to look at given time. The momentum seems like it's going to be there for a while. I was talking with Brian. I said to you earlier, I think, where can these types of ETFs slow down? I know some people might say this looks overbought, could be getting top heavy. But I think what's really going to change the tide for these types of ETFs is really going to be when we do find the vaccine, the one that's going to be the one that's going to save the world, and there's going to be, maybe concerns about distribution or pricing or access to everybody to that type of drug. That could slow the momentum down that we're seeing. And then also, of course, investors are always looking forward to the next 12 months. They're also going to kind of be like, well, what's next? The good news is, I think there'll still be government spending coming at this industry to help prevent something like this pandemic happening in the future. But that's where I would get more cautious. But until then, any positive headlines on any vaccine or treatment for the coronavirus could bode really well for these types of securities, right, Brian? So I know, again, like I said, it's really hard to just dive into a security like this, the XBI, when it's hitting a new 52-week high and it's up 25% in 2020. So options can be a great way to make a trade. Like, what are you seeing? What are you thinking when you look at this type of chart?
Well, I do. Yes, this is a little bit scary because usually stocks in general just don't go straight up, but this one's attempting to. So the trade that we're going to look at today, based off of everything that we just talked about, is called a back spread with calls. And I'm going to actually build this as the good, the okay, and the ugly. So if I look at this trade, it just means we're looking for more volatility. So we showed the chart today and we didn't have a lot of technical analysis just drawn on the chart. We just showed the chart of it going straight up because this really isn't a technical analysis play. What the play is that you're looking at news-based information. Now, if you want to just look at the biotechs some of the biotechs that Lindsey mentioned that are actually in the XBI, those stocks have extreme volatility. A lot of them, the Modernas, especially the smaller biotech companies. So it makes it almost a little tough to play options, because when you get extreme volatility in the underlying, the markets will get a little bit wider to try, just because the market makers cannot make markets in that type of underlying that is that volatile without widening the bid-ask spreads. So the XBI takes away some of that volatility, because in general, you're adding a bunch of different stocks, and if one goes up, the other one might go down, and in general, that will lower the volatility. So that's an interesting underlying. Volatility is still high. It's still up around 40%. The callback spread, I'm going to show you the real trade here. This is the trade inside the options playbook, the Ally Invest options playbook, and this is a graph at expiration, but it's a very interesting graph once you first put on the trade. Now, this is a little bit more advanced trade than we usually talk about. And as always, it's not meant to be a recommendation. It's just a paper trade this week. And I'll be back on Friday with the stock play of the day overtime. And I think it should be a real interesting overtime edition once we get some movement and we look at the pricing of these option contracts. So let's get to the Ally Invest option chains. We see the Biotech ETF, the XBI. It's trading at 119.77. It's up $1 today, just a fraction, a little less than 1%. We're going to use the August 18th expiration. Now, we want the potential for this underlying stock to move. More time is our friend. Why? Because there's more chance for news headlines to come out. But the further you go out in time, the harder it is to find a decent width between the strikes. Decent, and I'll explain that concept, I guess, a little bit later, but a decent width between the strikes and still get it done for a net credit. Because we need, if the forecast is quote unquote, because we don't really mind if it goes down, but if it goes down in this instance, this is the okay. We need to get it done for a net credit so that this blue line here stays above the x-axis, which is the stock price at expiration. So that's the okay, and this is the ugly, and we're going to address that if the stock doesn't move at all, what we'd like to do. Okay, so let's set up the trade. I'm going to look at 18 days out. One big thing that I want to look at before we get too far and select our strikes is if we bought the 120, we got the underlying stock right at 120. Yeah, 119.81. All right, so pretty close to 120. That's the most at the money strike that we have. So if we bought that call, this is the call side of the chain, and we bought that put on the put side of the train, it's approximately at the midpoint 8 points. So the marketplace is implying over the next 18 days that an 8-point move, or if we talk in percentage terms, a 6.5% move is feasible. So we want to keep that in mind. So what we're looking for here is a bigger than expected move. And if you don't think that that's going to happen, well, then you don't do this trade. But in general, we're looking for a bigger move than what is expected. And what we hope will drive that move is some type of news. The news could even be poor, could be bad, drive it more than 6.5% to the downside, or it could be good and drive it more than 6.5% to the upside. Our best case scenario is an upside situation, but our only real bad case scenario here in this strategy, and like I said, it's a little bit more advanced strategy, is if the stock goes nowhere for the next 18 days. That's by far our worst case scenario. So if I look at the option strategy workbench inside here, we see that if we buy the August 7th expiration 120 call, the most at the money call, but we buy 2 of them, we're going to sell an in the money call to pay for it. So we do have risk. The risk is the fact that we are buying 2 and selling 1. 113 to 120, that's 7 points. That's what we would like to see the underlying move, at least by this expiration date. In either direction would be okay. The best case scenario would be to the upside. So 80-cent net credit to the account right now, and let's make that officially the paper trade for this week by putting it in the right rail. I'll click on the midpoint. We're selling to open 1 of the August 7th 113 calls, buying to open 2 of the August 7th 120 calls. This is considered a ratio spread. It's not for the light of heart. It's a little bit more advanced. And we're going to do this for a net credit of 80 cents to the account. That means for every 1 by 2 spread that we do, it's all combined, the net credit to the account would be 80 cents. All right. So $80 less commission. If the stock goes down below our short strike, below the 113 strike, that's the maximum that we could make on the trade. On the upside, we have unlimited upside with the concept that stock doesn't very rarely goes unlimited or to infinity, but we're going to be long one more call option than we are short. So in general, we have unlimited upside. Okay, so I'm going to scroll down. And now here's the profit and loss graph in real time as opposed to the options playbook. And this is what I mean by a very interesting graph. Okay, so the stock is at 120. This is the only thing that we don't want to happen, or the worst case scenario, is that the stock just stays there, stays at 120 for the next 18 days and does nothing. If that's the case, this colored line is our profit and loss graph as of today. It's a very interesting profit and loss graph in that if the market does go down, it actually hurts the position to start, but at expiration, the colored line will start going towards the dotted line. If it goes up, we want it to happen right away because we're long 2 option contracts and short 1. We want as much time premium as possible. And if you keep scrolling on out, and I'll just zoom in here a little bit, you see that, yeah, this is what the graph looks to the upside. Much more upside than there is to the downside in this underlying trade. You do have additional risk. So even though you're doing it for a net credit, you're going to have additional margin risk on the trade. And that is the difference between the strikes, because from 113 to 120, that's 7 points of risk. That would be the worst case scenario. We'd lose that 7 points. It would stop right at that 20 from that short put spread that we've sold basically to help buy, and the short call spread that we sold to actually buy an additional call option, then it would sit right here. But as expiration approaches, let me show you how this line changes. Now I'm going to make a drastic move to expiration. Let's go all the way down to 2 days remaining to expiration and regraph this. Now the whole story has changed, right? If the market is going down, now we are positive below the 113 strike. We are starting to show a little bit of pain as we get down to the 120 strike, but we still got the unlimited upside potential anywhere above that high strike of 120, which is right about here where we start seeing the unlimited upside because we are long one more call option than we are short. So right around the 27 mark, which is the difference between this strike and that strike, we needed to be up in that range. Now, all right, that's a lot to handle. So let me just put some parameters around it. If I were to do this trade, there was 18 days remaining. Let's say there's 1 week of calendar days remaining, and the stock hasn't moved at all. Now, the graph is in theory. This is in theory. This is saying the current market conditions, this would be the case. If that stock hasn't moved at all and there's 7 days remaining to expiration, I think you just want to get out. You don't ask any questions, because then the graph becomes very negative in the last week. So right now it's still a decent graph if it goes down or if it goes up. So to me, this is a 2-week trade, but we're using 18-day options. I would love to use 25-day options, but then we'd have to even go wider on our spreads. In other words, we're doing a 7-point wide spread here. We need 7 points to the upside, 7 points to the downside would be the ideal scenario. But if we went further out in time, we might have to do a 10-point wide spread to be able to get it done for a net credit to the account. So a very interesting trade. Here is the good. Here is the okay, and this is the ugly. So we have 2 out of 3 scenarios where this trade will do okay if based on what happens in the biotech industry over the next 18 days. All right. So go ahead.
Can I ask you a question? First of all, I wanted to remind our viewers, we'll take questions at the end here. So be sure to write them in the chat box. We see a couple of you saying hello. That's nice. So I have a question for you. So you said we're doing an 18-day trade. After 2 weeks, if the stock hasn't done anything, you would just get out of it. Why you wouldn't why wouldn't you give it the extra week to see if it could move higher?
Okay, so this is where it is at right now. This is the colored line, and that's our profit and loss graph. When we first put on this trade, we would like it to go way up. That would be by far the best scenario on all different cases. But there's not a ton of risk, because as the market goes down or goes up, everything looks all kind of hunky-dory. But now I'm going to go all the way down, and I'm going to notice I'm going to change this to 11 days to go. And it's going to regraph this entire profit and loss graph. And at that point in time, we've gone down a little bit on our profit and loss graph. Now, this is assuming that implied volatilities don't change, that market conditions are similar to as they are today. But I'm still okay in most scenarios here. And okay means I have limited downside at this point in time. But if we hang around and in that last 7 days remaining to expiration, let's go all the way down to 3 days remaining, right? Now, all of a sudden, it's like, wham, in general, right? Because that's where your real risk comes from, is that last 7 days of time decay in this position overall. So why not just avoid them and say, well, you know what, if it hasn't made this move and I have 7 days or even 5 days, you can pick that number if you would like. Obviously, I don't want you to be in it. If it's sticking right around 120 and there's only 3 days remaining, obviously you should be getting out at that point in time. But this is a trade where it's just all really about time decay. You're just going to sit here and hope that some news drives this underlying stock either higher or lower overall. Hopefully higher. That's usually going to mean it's good news. And we have more upside potential if it goes higher. So I'm going to zoom back out and just show we're long one more option contract than we are short. So that means to the upside, there is no limit as to what this strategy could make. Now, the biggest downside of the entire trade is we got 18 days for it to play out, right? It would be nice to have, I'd really love to be able to do this trade with the same parameters and have, 90 days, but that's just not going to happen. That's not going to happen in the options world. So our play today is 100%. We're expecting more volatility than what the marketplace is implying right now in the XBI going forward over the next 18 days. All right, Lindsey, back to you. Any other questions that we have?
That's all I had, and it doesn't seem like there's any within the YouTube channel right now, but you guys can ask them, and Brian will be back on Friday with Stock Play of the Day overtime at noon to review this trade and make any suggestions to how you could adjust the trade depending on what has happened over this week. So it's really something that you should tune into. And if you think of any questions after this, you can ask him on Friday. So
go ahead.
What's that? So that's going to do it, I think, for our show today. But again, Brian will be back on Friday at noon. So tune in then, and the two of us will be back at it next Monday.
All right. Thanks, everyone. Don't forget to click subscribe and ring the bell so you get the alerts for the Stock Play of the Day overtime. Thanks for coming.